Hi everyone, welcome back to Corporate Decoder, the place where we sift through the boring corporate jargon so you don't have to. Today we are diving into the world of alternative investments, but be warned, this company's report is so detailed it might just give you financial indigestion. We're cracking open the annual shareholder report for the Blackstone Alternative Multi-Strategy Fund. This fund is all about mixing it up using different investment strategies. Think a financial smoothie. This report covers April 1, 2024 to March 31, 2024 to March 31, 25. So let's get to it and see what really happened during this period. Turning over for a moment, this report also provides the trading symbol for each share class. First, let's see how much it costs to run this complex machine. Here is a hypothetical $10,000 investment for their most common share, the Class I shares. For every $10,000 you invest, it costs you about $313 or 3% as a percentage. Whether you think that's a bargain or highway robbery is up to you. So how did the fund actually perform? Cassandra Class I shares returned 4.3% during the period. They also want you to keep in mind they are not a good predictor of the future, but that's true for all investments. It gave a few key performance drivers to explain what happened. Let's take a look. The winners: quantitative equity strategies, emerging market debt, and macro interest rates trading. So basically using math to make money in stocks and bonds are the losers. Commodity trading advisors, strategies based on mean reversion, which basically means that things will eventually even out. Healthcare focused equity strategies and even investments in carbon credit allowances. All these strategies saw weakness. To give a longer view, they also include this table, which shows the cumulative performance of a hypothetical $100,000 investment since March 2015, and compare it to a few different market indexes. It seems to show that the fund struggled in early years, then was steady, but generally underperforming the MSCI World Total Return Index. If you rather look at percentages, here is the average annual total returns for the past 1, 5, and 10-year periods. To get a sense of how they performed in the long run, here's a quick look at a few more key stats. The fund's total net assets, roughly $3.7 billion. Total holdings over 5,000, which sounds like a lot to manage, and the portfolio turnover rate is 0.397, which is very high. Total advisory fees were $60 hours and $20.45, 845 buzz. Keep in mind that this fee is paid to the sub-advisors, and the manager makes money on top of that. Now for the fun part, any drama or shakeups? Well, there were quite a few changes in the lineup of Span sub-advisor Span. New teams were added for equity hedge and relative value strategies, and a few other teams were removed from macro, equity, and event-driven strategies. It seems they are always shuffling the deck, hoping to find the right combination. Let's check, what are they actually investing in Tefanet? It seems this fund has investments everywhere. However, at the high level, here is the portfolio composition. Common stocks take a large chunk at 27.5%, followed by mortgage-backed securities at 16.9%, investments in other funds coming in at 10.6%, and then a few other minor categories and cash and other assets. One big item here is that securities sold short takes up 34.8%. It is the opposite of owning it. They are betting against these securities. This could be very risky since you can lose more than you invest. Before moving on, let's do a quick scan of how the other share classes are doing by looking at some highlights of the Class D shares. The return here, 4.1%, is slightly lower than Class I. They also call out who the performance detracted from 10T. Now let's do a quick scan of how the other share classes are doing by looking at some highlights of the Class Y shares. As you might expect, this share class did slightly better, clocking in at 4.44% since they have lower fees. In general, performance drivers were the same. What does this all mean? Well, it's a mixed bag. The fund has some solid performance, particularly given the volatility in recent years. However, the high turnover and complex structure can raise eyebrows. It's hard to say whether these moves are really benefiting shareholders or just generating more fees for the managers. I'll type to cheer. Now let's zoom out and put it all together. The Blackstone Alternative Multi-Strategy Fund offers a really mixed portfolio, which aims for lower volatility. It tries to do this by investing in a whole bunch of different things, using sophisticated strategies. If you are looking to have someone else take care of everything, this may be a worthy choice, but in my opinion, you could probably find ways to generate similar returns at a lower cost. What do you think about this fund? Let me know in the comments below. If you want to learn more about decoding the financial world, make sure to subscribe. Also join our Discord community, link in description. Thanks for watching. I'll see you in the next one.